Hello and welcome to Investing Confidential, where we're going to give you what you don't hear from the pundits on CNBC and maybe most of YouTube, where we cover everything macro and what's happening in the world. Obviously, today markets are taking a hit. It's not as bad as you might think. In fact, though I'm very bearish and have been bearish for some time, I think if you're a trader right now, you might be looking for an opportunity. What you're seeing right now is bearishness readings. We are definitely in oversold territory. Not only that, it pretty much everyone's gotten real bearish. And when everyone gets bearish, you're going to get these counter-cyclical trading rallies. So if you're a trader and you're looking at this chart and you're watching CNBC, and now, when you start seeing the stock market being talked about on the local news, it's time that you're probably going to get some type of relief rally. And again, it is going to be only a relief rally. How long it lasts? Well, the July rally lasted for about 3 or 4 weeks, so who knows? Some of the biggest rallies in the history of the U.S. stock market happened during bear markets. So it's certainly the numbers are telling you that we're getting oversold here. But again, this is a short-term phenomenon for traders only. If I'm an investor, I'm certainly not putting money to work today. Well, the market is getting back to reality. After 10 years of QE and declining rates to zero around the world, not just in the U.S., this was all artificial. There was no reason for it. Governments do not want business cycles, okay? I'm going to talk about this in the future, but the reality is governments realize that when there's a business cycle and there's a downturn, so a business cycle is meaning when there's an upturn, it's going to be followed by a downturn, followed by an upturn. Well, the governments don't want downturns because it's bad politically. So they've used the central banks around the world for many decades, especially the last 10 years, to basically try to eliminate business cycles. This is a disaster. It doesn't work. They've printed tons of money. This is why Bitcoin is popular. This is why people are awake now, watching what's going on and not liking what's going on. These policies, and it has nothing to do with political party because these policies have been enacted by both sides of the aisle, are really bad. And now the chickens are coming home to roost with rates finally getting normalized. And a lot of this excess, this real excess in companies that really shouldn't have been in business are going to go away. All this craziness has been going on in the real estate market, funds buying thousands of houses sight unseen to rent and leverage and rent. All this is coming to an end. The key thing to watch here is the 2-year bond. As I mentioned the last 3 videos, the 2-year bond now is at almost 4.5. They're saying now that 4.5 may peak. I disagree. I think we're going to go to 5, maybe 6%. We're going to overshoot. And we're going to see an inverted yield curve. And that's what we're seeing today. It's going to get more inverted. What does that mean? Well, as I mentioned to you before, this whole idea of TINA, there is no alternative. I spoke about this a number of days ago. Now everyone's jumping on the bandwagon. Robinhood now offering 3% on cash. They're not going to be the only one. By next week, you're going to see money market rates at some of the big banks rise pretty dramatically to draw in cash. It's a very good ploy for these banks to draw in cash. They probably won't offer 3%, but 2%, 2.5% is almost guaranteed on these money market rates. And then there's your alternative, right? So if you can get and even a 2-year bond, if you buy a 2-year bond right now through your broker, you're going to get 4.25%, 4.3% after fees, and your money's locked in for 2 years guaranteed. Okay, if you think the stock market, if you're a good trader, maybe you don't want to do that. But if you think the stock market's going to be volatile, and it will be volatile for the next 2 or 3 years, probably longer, 4.25%, 4.3% is a good rate of return, believe it or not. It's not going to beat inflation, probably going to be even with inflation over a 2-year period, but at least you won't lose money. So inflation, just to mention, inflation is coming down, folks. Here's some anecdotal evidence. You've got supply chain, which is coming back to normal. Supply chain inflation, which was really bad for a while, is coming back, and it had to come back, and it is coming back. You have also, you're looking at shipping rates here. So shipping rates exploded for obvious reasons during the pandemic. Those rates are coming down pretty dramatically. So again, and we also showed a chart a couple of days ago, if you can go back and look at it, on the ports. The slowdown at the ports is over. Shipping rates are coming down. So now, this is not to say that inflation is going to reach the 2% target that Powell said it's going to reach. There's no chance of that happening anytime soon. You're going to see rates come down probably in the short term to 7%, 6.5%, maybe early next year to 5%, and then we're going to stick. Because the biggest problem is monetary inflation, the printing of money. We've printed so much money, and it's being hidden right now because of the dollar strength and because our rates are going up, and it's creating an artificial dollar strengthening. But the chickens are going to come to roost on the dollar as well, but it's not going to be for a while. But inflation has peaked. It's not going to come down that much, but it is going to come down off the 8.5% highs to probably more like maybe 6% by the end of the year. No chance of reaching the 2% target. So what does that mean? That means Powell will continue to raise rates. Okay, he's put a line in the sand. He's not going to go back on that because he's already lost all the credibility he has. He doesn't lose any more of it. The little credibility he has left, he's going to keep raising rates and forcing this economy deeper into recession. Not into recession because we're already in a recession, deeper into recession. What does that mean for stocks? Valuations. Okay, when rates are zero, valuations ride high. 20 times earnings, 24 times earnings, 26 times earnings at the peak. Where now that rates are being normalized, historically, PE ratios are around between 14 and 16 times on the S&P. That's historical norm. Okay, when they get over 18 to 20, they're overvalued. When they were in the mid 20s, which they were a couple of years ago, it's time to get out of stocks completely. We're probably right now a little under 20 times earnings. I mean, you're going to hear other things from the Wall Street banks, but they're biased, so you cannot go by what any of the Wall Street banks are saying. They're not credible anymore. I want to mention now something that nobody's talking about. You probably haven't heard before, unless you've spoken to me. It's the amount of leverage that's in the market right now, and it's staggering because you won't see it because it's mostly off-balance sheet leverage. What do I mean by that? Let's look back at this whole idea of the wealth gap, right? This is the leverage I'm going to tell you a long story, but this must be told. The whole idea of the wealth gap. The whole idea of the wealth gap is obviously what the top people are earning versus what their, let's say, lowest paid worker is earning. That's the largest we've ever seen, and it's because of the stock market. It's not because of people's salaries. It's because of the stock market. The amount of compensation that executives get from the stock market. You take people like Elon Musk and Jeff Bezos, and they say, they don't pay taxes. And Jeff Bezos paid less taxes than his secretary. Percentage-wise, his tax rate was less than his secretary. Well, that's because Jeff Bezos, Elon Musk to a certain extent, and I use them as the canary in a coal mine, but it's happening all over. Top executives, top founders, when they want to raise cash, they don't have to sell stock. They just go to Morgan Stanley or Goldman Sachs or JP Morgan and borrow off their holdings. So someone who has, 200 billion or 100 billion in stock borrows 3 billion, 4 billion. It's no big deal. And the banks love it because back then when they were doing this, aggressively over the last 5 or 6 years, they're making big spreads. The guy who borrows $1 billion off a $20 billion portfolio, hey, pay 3%, no big deal. He's just happy to have his money and not pay tax on it. Well, that phenomenon has spread throughout all the tech workers, right? So it's not just the $100 billion guy. It's the $1 billion guy. It's the $500 million guy. It's the $100 million guy who are being approached by their wealth managers, and I put that in parentheses, and with these programs of borrowing off their holdings. Now, when the stock markets are going up, it's a great deal, right? You borrow off. If you have a $100 million portfolio, and by the way, there are a lot of people with $100 million in stock on paper stock gains over 2 years ago. You go in as a tech guy, you got your 100 million, you borrow 5 million, you borrow 10 million, you borrow 30 million, you borrow 40 million, you're buying real estate, you're buying cars, you're buying houses, whoever. And it's wonderful because you're paying no taxes. But unfortunately, when you sign that document that gives Morgan Stanley or JP Morgan or Goldman Sachs the right to hold your loan and pay them interest, what you don't realize is that when chickens come home to coop, meaning stock prices start to go down, then there's hell to pay, right? So the broker will come to you and say, hey, your collateral's down. You now owe us, you have to deposit $3 million in cash. No, I'm not going to do that. Boom, they sell the stock. Boom, they sell the stock. Look at what happened to Peloton. Okay, look what's happening to Zoom. If you don't think that there's leverage in the system, look at the damage, destruction that's happening on these stocks. And it's not investors, it's not small investors who are selling. No. Behind the scenes, this is something you're not going to hear. You got all these executives who borrowed from their shares, took the money, gave their stock as collateral to these banks, and these banks take no prisoners. When they reach that threshold, they dump it, they sell. They do not want to take losses on these loans, etc. So this is what happened in all these instances, Peloton, Zoom, it's happening across the board. And you're going to see it accelerate. So we haven't even reached the levels yet in the broad range of the market that this is going to, but it's going to be a significant event when this starts to take place across the board. We'll see it in tech first, but it's going to happen all over. And things like Apple and all these other big companies, when these stocks start to break, they accelerate. They, what we call waterfall. They waterfall lower because of the leverage inherently in the system, meaning individuals, executives with significant amount of paper wealth, they borrow to not pay taxes, and then boom, stocks come down and they're forced to sell. Now, what happens when they're forced to sell? Well, they got to pay taxes. This is why I also say that I've talked about real estate coming down across the country, New York, San Francisco, Los Angeles, not seeing this, Miami. When your stock goes down and the tax man hits you with a big bill and you have your third and fourth home in Miami or the Hamptons, you're going to have to dump it. And because you have no liquidity, this is an illiquid asset, and you're going to see these luxury areas start to take the hit probably in 6 months or so. But, again, no one believes it right now, but you heard it here first. Now I want to talk about something that happened yesterday across the board with these rate hikes. So you saw yesterday, again, I don't know if you saw it, but many of the countries in Europe and primarily Asia all raised rates yesterday, last night, the day before, across the board. They had to. They have no choice. Their currencies are getting destroyed by the strengthening dollar. They're also suffering worse on inflation, and they've been hiding, especially in Europe. They've been hiding, and they can't hide anymore, these governments. They have to raise rates. Sweden, Germany, the whole Eurozone is suffering from massive inflation, and rates are going up all over the world, with two exceptions, Turkey and Brazil. Turkey's a mess. Brazil actually took the best road of everyone. They raised rates 2 years ago, started to raise rates, and their rates are now at 15, 16%. Okay, so they have a real return, even though they have, inflation at, 8, 9%, they have real positive return. So Brazil's in pretty good shape. In terms of their monetary policy, their economy suffering, but they are a global commodity producer. I think Brazil's going to be in very good shape after the election, but that's a story for another time. So all these countries around the world raising rates. What does that really mean? That means, number one, that we're in a global recession, point blank. Europe is in a recession. China's pretty much in a recession, though you'll never see it with the numbers. The rest of Asia with rising rates are going to go into some type of slowdown. So we are in a global recession. So we haven't seen that. Probably since the 70s, we haven't seen this type of global recession. But then again, in the 70s, we did have places like Venezuela, Brazil, other commodity doing very, very well. So, but now we have there isn't one country with the exception of India that's doing well. Everyone is suffering. Who's suffering the worst? Well, certainly Japan is one of the countries that are suffering the worst in terms of their currency, in terms of their whole fiscal situation, in terms of their monetary policy. They've got issues. But their stock market's cheap, and it can be something that could be very interesting because of the destruction in the yen and the euro. So the Japanese companies are exporters, so traditionally, so they bring in a lot of hard currency. The companies, I would say on the whole, large cap companies in Japan are in good shape. Valuations are interesting. It might be a place to take a look at. Who else is suffering? Obviously, the euro and the rest of the European countries, they're just beginning. They've got serious issues, and it's certainly something to look at because, again, going back to what I said in the last few videos, our tech companies, Apple, Tesla, they sell a lot overseas. They're selling into declining currencies. When you bring that back into the US, when your earnings are quarterly earnings, it's going to be a disaster. So inflation's coming down, but it's not going to offset the disaster we're going to see in earnings in the next third quarter, fourth quarter, first quarter, second quarter. It's going to be a mess, and this will contribute to continuing declines in the stock market. I just want to mention one thing. I mentioned the euro. Look at this consumer confidence. So most developed countries around the world are not manufacturing hubs. They're consumer-led economies. Look at the consumer confidence in the Eurozone. It's a disaster. Okay, that just tells you, that's a leading indicator of what's about to come. One final thing, I keep skipping around here, just gold. I hear a lot of people saying gold is oversold. No, gold is not oversold. Gold is broken down. I think gold is going to be, I like gold here. I mean, I like gold in general, but I think the next level is around 1,1500. You could probably stop buying a little gold soon. I think gold is going to be the asset to own over the next 5 to 10 years. But certainly in the short term, the U.S. dollar is just crushing gold. So you have to just stay away and let the weak sellers out. And that goes with Bitcoin as well. We're seeing that, as I mentioned the chart yesterday. Bitcoin is the weak sellers are getting out, and it's just the whales, the long-term holds that are holding. That's what you want to look at, and eventually to find a bottom. And finally, I want to mention China. China is something I probably should talk about more often because I've been there many times in the past. Did a lot of investing in China. China's consumer has stopped. Okay, the consumer confidence or the consumer have just stopped buying. And you look, how do you know that? We look at real estate. Real estate has historically been, for the last 20 years, the engine of growth. I'm going to do a video just on China to sort of educate people on this. But you look at this, and anyone who understands China, when you see that the Chinese people have just held back and are no longer buying real estate, that means that their confidence in the government, in real estate, in buying things in general, is just shot. We haven't seen this in a very, very long time for this long period. This has huge ramifications globally. Again, everyone in the world wanted to sell into the Chinese market. Every tech company, every, Tesla, everyone has manufacturing facilities and wants to sell into the Chinese market. Well, the Chinese market right now is frozen in terms of consumer buying, even the luxury goods. And this is, again, going to contribute to just really, really tough earnings seasons starting in October, probably going through the second quarter. What's happening in the rest of the world is really the issue. And the United States, obviously, Fed policy is a major issue, being behind the curve, being totally lost, and contributing to what is going to be another financial crisis. Well, listen, on that note, have a great weekend and happy trading.